In Chapter 5, we're going to look at all types of consumer credit. This is probably one of the most important topics in this course. The use of credit is a major force in the U.S. economy. Misuse of credit causes a variety of problems, both personal and financial, for individuals and families. Wise use of credit can make life easier. Unwise use is the road to disaster. These are the learning objectives for this chapter. As with previous chapters, we'll work our way through these one by one. First thing, we need to evaluate the pros and cons of using credit. Second, what are the different types of credit available? Where do you get them? If you're thinking about applying for credit or a loan, can you afford it? Learn to calculate the cost of credit. And if you're going to use credit, be prepared to protect your credit rating and manage your debts. Before we look at the advantages and disadvantages, we need to be clear on our definitions. Credit is an arrangement to receive cash, goods, or services now and pay for them later. Consumer credit refers to the use of credit by individuals, excluding home mortgages. As mentioned, consumer credit is a major force in the U.S. economy. Before you plunge into using credit, consider, do you have enough cash for the down payment, or do you want to use savings for this purchase? Does the purchase fit in your budget? You do have a budget, right? Could credit be used in a better way? Do I need this now, or could I postpone it? What are the opportunity costs, the trade-offs of postponing this purchase? What will using credit cost in money, psychologically? So what are the pros of using credit? Most obviously, you get whatever you're buying now. It allows you to make purchases when cash is low. Credit does provide a cushion for emergencies. That means you should not max out your credit cards. Have that emergency cushion available. With store credit cards, you get advance notice of sales and coupons. It is far easier to return items bought on credit. It is much easier to shop when using credit. A big pro is that your monthly statement provides a clear record of your expenses. Continuing with advantages, if you use one major card for virtually everything, you have one statement of everything and one monthly payment. It is far safer than carrying cash. Shopping online and hotel and car rentals require a credit card. You can take advantage of the float time. Many cards offer rebates, miles, points, or other rewards. Very importantly, wise use of credit indicates financial stability. Lots of advantages, but some downsides as well. It is easy to be tempted to overspend. After all, it's not real money, it's plastic. You're committing future income so it can slow progress towards your financial goals. If you don't make a payment on time, the merchandise can be repossessed. Credit costs money. You're using someone else's money and they charge for that. So the bottom line is it worth it? There are two basic types of consumer credit. Closed-end credit is what you use at Best Buy to finance a TV. The credit is for the TV only and has a specific payoff schedule. Opened-end credit typically has a credit limit, but it can be used for anything, either in a specific store or any store accepting that credit card. A Macy's card is open-end credit. Visa is also open-end credit. Taking a closer look at closed-end credit. These are one-time loans for a specific item to be paid off over a specified schedule. Mortgages, car loans, and as mentioned, that TV at Best Buy are all examples of closed-end credit. The three most common types are installment sales credit. This allows you to purchase a large ticket item, furniture, a car, a home. Usually a down payment is required and a contract. Installment cash credit is just what it says. You get cash for home improvement or vacation expenses, usually no down payment there. And a single lump sum credit, usually used to purchase a single item. Repayment is a total lump sum of the price plus the interest. This chart in your textbook clearly shows how installment credit has ballooned in the U.S. from $12.42 billion in 1996 to $30.99 in 2013, almost threefold. Opened-end credit generally refers to store or general use credit cards. The home equity loans are included in this group. These types of credit have a set credit limit based on the income and employment information you supply to the issuer. You can spend up to your credit limit. If you do not pay the bill in full by the due date, you'll be charged interest, and it can be significant. Paying the minimum payment is courting disaster. You should be working on Project A and seeing what happens when you only make the minimum payment each month. Revolving check credit is basically a bank line of credit that allows you to draw against it as needed by writing a specific type of check. Here's a subject most of us already know about: credit cards. According to the text, the average cardholder has 9 credit cards. Online sources report this number has been declining since 2014, with the percentage of Americans with no credit cards rising to 29% in 2014. Credit card users fall into 2 categories. Convenience users pay off their balance every month. This is what you should aspire to be. Then you don't care what the interest rate is. Borrowers do not pay off their balance each month. Most cards offer a grace period during which no finance charges are added to your account. After that, finance charges apply. Issuers frequently offer teaser rates to entice new users, and then the rates rise after a few months. Many, if not all, cards today offer some type of reward program: points, miles, cash, which can be enticing. Delta American Express offers Sky Miles. American Express Blue Cash offers cash. Discover offers cash. Amazon Visa offers points to use on Amazon. A kind of gray zone: debit cards or credit-like cards. Debit cards can deduct money from your linked account immediately. Many banks offer their ATM cards as both ATM debit and credit cards if you choose to use them in all 3 ways. Stored value cards are gift cards or prepaid phone cards. Smart cards with an embedded chip are the new norm in credit cards in the U.S., though they've been in use outside the U.S. for some time. Touted as safer than swiping, inserting a smart card is supposed to provide more security at checkout. So-called T&E cards like American Express are an example of convenience cards. The full balance is due each month, but Amex also offers other card options that act as standard credit cards, like Blue Cash. The latest innovation in credit is paying via your smartphone. Using Apple Wallet, Samsung Pay, or Android Pay, you can simply hold your phone near a terminal and have it beam the needed data. With the iWatch linked to Apple Pay on your iPhone, you can do the same with the watch. Research says that paying via phone is faster than inserting a chipped card and safer. So where do you get consumer credit? Loans are basically just borrowing money with an agreement to pay it at a certain time. The most inexpensive loans are from parents or family members. Medium-cost loans come from banks, S&Ls, and credit unions. Expensive loans are available from finance and check cashing firms. Depending on current promotions, retailers may be expensive or running a deal: 0% for 72 months on a new car, or 0% on a TV for 2 years. Bank credit cards and cash advances tend to be very expensive. If you need to borrow money, work your way from least to most expensive. Home equity loans are quite commonly used for home improvement, but the money can actually be used for any purpose. The main point is your home is pledged as collateral against the loan. Keep that in mind. These should only be used for major purchases, if not for home improvements. Current tax law, however, allows you to deduct the interest on a home equity loan just as you do the interest on your mortgage. Here's a simple home equity loan example. Your home is worth $200,000. You owe $125,000 on the mortgage. If a home equity lender will allow up to 80% loan to value, how much can you borrow? $200,000 times 80% is $160,000. You can borrow $160,000 minus $125,000, or $35,000. This table in your text gives a recap of credit sources, types of loans, and general lending policies. So, can you afford a loan? Basic considerations. Can you meet all your essential expenses and make the loan payments? What are you planning to give up to make those payments? 2 general rules of credit capacity. Here's the first rule. Your debt payments to income ratio should not exceed 20% of your net income. 15% is better. 20% is the max. This refers to consumer credit payments, and it doesn't include your mortgage payment. The second rule of credit capacity. Your debt-to-equity ratio should be less than 1. You should have more net worth than you have liabilities. Debt-to-equity is total liabilities divided by net worth. Your mortgage is excluded from the numerator. The value of your home is excluded from the denominator. Let's walk through an example of calculating these credit capacity ratios. Sam's monthly debt payments are $825, not including his mortgage. His monthly net income is $2,425. Total liabilities, $9,400. Net worth, $24,750, excluding his home. Sam's debt payments to income ratio is 825 divided by 2425, or 34%. This is way above the 20% maximum. Sam needs to get his credit in order. His debt to equity is 9,400 divided by 24,750, or 0.38, less than 1, so in this case he's in good shape. When you're ready to apply for a loan or credit, these are the criteria a lender or card issuer will be looking at to determine if you're creditworthy, called the 5 C's of credit. Character. Will you repay the loan? Have you shown yourself to be a responsible user of debt, repaying loans in the past? How long have you lived at your current address, been at your current employer? Capacity. Can you repay the loan? How much do you make? What other liabilities do you have? Capital. What are your assets and net worth? If you're applying for a mortgage, the issuer will want a net worth statement clearly detailing your assets and liabilities. Collateral. What if you don't repay the loan? Are you offering any assets as collateral against it? Conditions. Is your job secure? The bottom line of all of this is your credit rating. Your credit report is a complete history of your use of credit. There are 3 major credit bureaus: Experian, TransUnion, and Equifax. Credit bureaus receive data from banks and businesses on how well you meet your debt obligations. Credit files contain a vast amount of information. The basics: name, address, social security number, date of birth, your employer, what your position is, your income, how long you've been there, whether you're a homeowner or renter, all credit-related events. The Fair Credit Reporting Act of 1971 requires that out-of-date information be deleted from your file. It gives consumers, you, access to your file and the ability to correct erroneous information. And it places limits on who can obtain your credit report. So who can obtain your report? Only authorized persons for approved legitimate business purposes. It can also be supplied in response to a court order, and you can request a copy yourself. Unfavorable information can only be reported for 7 years, but bankruptcy can remain on your credit report for 10 years. These time limits can be waived if you're applying for credit greater than $75,000 or for life insurance in excess of $150,000. So what do you do if you suspect incorrect information is in your credit report? If you're denied credit, you can request a free copy of your credit report within 60 days of the denial. We're all allowed 1 free copy a year. If data in your report is incorrect, you can sue the credit bureau or the creditor who caused the harm. The standard credit score is called your FICO score. FICO comes from Fair Isaac Corporation. FICO scores range from 350 to 850. The higher the score, the less risky you are. They can be obtained from several sources for a fee, for free from some, and they're now printed on your Discover bill. The VantageScore is a new credit score developed by the 3 bureaus together. Scores range from 501 to 990. The model is supposed to be more predictive and better for those with limited credit histories. For those with very limited credit histories, the PRBC, Payment Reporting Bills Credit System, offers an alternative way to demonstrate creditworthiness. The PRBC system records timely payment of rent and phone and utility bills, for example. So what if you apply for credit and are denied? You need to be aware of the Equal Credit Opportunity Act. All applicants must be given the same rights. Applicants cannot be discriminated against due to race or nationality, age, receiving Social Security or public assistance, sex, or marital status. The Equal Credit Opportunity Act requires that if you're denied credit, you must be told the reason why. And remember, if the denial is based on your credit report, you have the right to be told your credit score and to receive a free report within 60 days. If you're being quoted a higher interest rate due to risk factors, this must be fully disclosed to you that so-called risk-based pricing is being used. This diagram in your text provides a clear path as to what to do if you're denied credit. The left-hand leg covers what to do if the reason for denial is valid. Ask about alternatives available, apply to another lender who may have different criteria, improve your score. The center leg, if you're not sure, ask. The right-hand leg, if you believe the reasons for your denial are invalid or discriminatory, file suit. If your credit score is not where you need it to be, how do you improve it? The first step is to get copies of all 3 credit reports and verify all the information. Religiously pay your bills on time. Understand what goes into your credit score and what you can do to affect it. If legal steps are required, learn what they are and proceed. And beware of credit repair scams. This chart in your text shows what forms the basis of your credit score. 10% new credit, 10% the types of credit used, 15% the length of your credit history, 30% amounts owed, and the big one, 35% payment history. As you can see, a great deal depends on how much you owe and your payment history. These items are shown on the chart. More information is available from the federal government at the website shown on the slide. Using other people's money is not free. If you borrow money, which is in effect what you're doing, whether you receive cash or a product or a service, there are finance charges. How large these are is critical to your decision whether or not to use credit. Typically, a finance charge is the dollar amount you pay above the cash purchase price to use credit. It includes interest, fees such as service charges, credit-related insurance, and appraisal fees for a home loan. Remember, finance rates must be quoted as APRs. The APR is the periodic rate times the number of periods per year. You should shop around. Credit can vary widely. Here's an approximate APR example. The loan amount is $400. The term is 3 years, the payment schedule is monthly, and the total finance charge is $54. The approximate APR is shown on the slide, 8.76%, where lowercase n equals the payments per year, which is 12. Capital I is the dollar cost of credit, which was given, $54. Capital P is the net loan, $400. Capital N is the total number of payments, 3 years times 12, or 36. Plug those numbers in. Our approximate APR is 8.76%. When considering a loan or financing, there are trade-offs, features you'd like versus the rate you'll have to pay. A shorter-term loan is less risky for the lender, so you'll get a lower rate, but your payments will be higher. You might like a low-payment loan with a large balloon payment at the end, but this is risky for the lender, higher rate. Basically, the riskier a loan is for the lender, the higher the rate he'll demand. What can you do? Accept a variable rate, provide collateral, make a bigger down payment, take a shorter-term loan. This slide defines 3 ways the cost of credit can be calculated. Simple interest is just that, simple. The rate times the amount borrowed, times the time. Simple interest on the declining balance, interest is charged on the remaining amount outstanding on the loan. Add-on interest is calculated on the original total added on to the balance before the periodic payment is calculated. We're going to walk through an example. Scott needs to borrow $6,000. He has 3 choices. Option 1, 6% simple interest, term is 3 years, it's a lump sum payment at the end. Option 2, 6% interest on the declining balance, 3 years, annual payments. Option 3, 6% add-on interest, 3 years, annual payments. We're going to look at how these play out in the APR on each one. Using simple interest, we can find the total amount of the loan to be repaid as the loan amount times 1 plus the rate raised to the power of the term of the loan. 6,000 times 1.06 raised to the third power is 7,146.10. So interest paid is the difference, $1,146.10. Using our approximation formula, we find an effective rate of 6.4%. Note that the lowercase n is 1/3. Since this is a one-time lump sum payment at the end of 3 years, the number of payments in 1 year is 1/3. Option 2, using simple interest on the declining balance, yields an actual rate of 6%. Look at year 1. The payment is 1/3 of the principal plus 6% of the outstanding balance of $6,000 for a total of $2,360. Year 2, the outstanding balance is now $4,000, so the payment is 1/3 of the original $6,000 plus 6% of the outstanding $4,000 for a total of $2,240. You repeat that for year 3. Ends up total interest paid $720. Contrast that against the $1,146 from simple interest. And option 3. This is the add-on interest. We repeat our total interest calculation from option 1, finding total interest of $1,146.10. Adding that to the $6,000 loan and applying our approximation formula yields a 9.6% rate. So if the total interest paid in option 3 is the same dollar amount as in option 1, why are the rates so different? Because in option 3, the interest is paid in all 3 years, not just at the end. Time value of money. Here are our 3 options in table form. Clearly, the simple interest on the declining balance is the best option for you as a borrower. A bit more about the cost of credit. Remember, lenders are required by law to quote you the rate as an APR. Lenders will incorporate expected inflation into the rate they quote. And finally, avoid the minimum payment trap. Credit card statements now must show you how long it will take you to pay off your balance if you make the minimum payment. Project A should help you see this clearly. Once you have credit and a decent credit rating, you need to protect it. Your credit rating can not only affect your ability to buy a car or a home. Prospective employers may check your credit rating. A strong rating indicates a responsible adult. Car insurance rates can also be affected by your credit rating. Same reason. So let's look at the laws, and there are a lot of them, that help you protect your credit. The Fair Credit Billing Act of 1975 has the following provisions. You are required to notify a creditor in writing within 60 days of an error. You must pay the part of the bill not in dispute, and the creditor has 30 days to respond. They're given 90 days to either correct your account or explain why. Continuing with the FCBA. A disputed item won't affect your credit rating while the dispute is active. You can withhold payment on damaged or poor quality items if purchased with a credit card, but you're required to make a sincere effort to resolve the problem with the creditor. Identity theft has been a huge issue. Here's what to do if you believe your identity has been stolen. Contact all 3 credit bureaus immediately to institute a fraud alert. Check for any accounts not opened by you and cancel them. Big red letters. File a police report. This is critical going forward to demonstrate the validity of your claim and establish the date of the event. To protect yourself on an ongoing basis. Shred any documents with personal information that could be used to steal your identity or fraudulently use your credit. Shredders are cheap. If you suspect a problem, contact the creditor and close the account. Make sure to get your credit card back after a transaction. I know people who never let their credit card out of their sight. If going out to dinner, they take enough cash. Keep a record of your credit card numbers and the 800 numbers to call in an emergency. And this should go without saying. Contact your credit card company immediately if you suspect a problem. Truthfully, the major credit card companies are watching your transaction history, and they may well be the one to call you if they see something that doesn't look right. I've had Visa call me to ask if I was making a purchase at a Toys R Us in Dallas, since that didn't fit with recent transactions. It wasn't me. They denied the charge and issued me a new credit card. Well, we all shop online, and a lot of us bank online. Online security is critical. Major browsers are relatively secure. Internet Explorer, Edge, Chrome, Firefox on Windows, Safari on your Mac or iPhone. Of course, keep records of what you do online and review your statements to make sure they match what you did. I truly believe no one actually reads the privacy and security policy of a website. You just click agree and move on. But we really should read them. Do we have to say, keep your personal information private and do not share your passwords? And do not download strange files or click on links. Phishing is so prevalent. I get about 3 phishing alerts a week from Ole Miss. Just because it looks like it came from your bank doesn't mean it did. You can hover over the link and see where it really goes. Links can be faked. A special caveat on credit. Co-signing a loan. Think long and hard before doing this. If the lender is requiring a co-signer, it means that the borrower doesn't have good enough credit to get it on their own. If you co-sign and the borrower defaults, you're liable for the full amount plus any fees. If you're having a problem with consumer credit, your first step is to contact the creditor and try to resolve it. If that fails, file a formal complaint. The next slide lists a variety of consumer protection laws available to protect and assist consumers. Here are 8 major consumer credit protection laws currently on the books. Truth in Lending and Consumer Leasing Acts, Fair Credit and Charge Card Disclosure Act, Equal Credit Opportunity Act, Fair Credit Billing Act, Fair Credit Reporting Act, Consumer Credit Reporting Reform Act, Electronic Funds Transfer Act, Credit Card Accountability, Responsibility, and Disclosure Act of 2009. You'll be happy to know we are not going to go over each of these. The point is for you to realize the breadth of laws available to help you with a problem. Under all the consumer credit laws, you have the right to complain to the creditor, to file a complaint with the government, and ultimately sue the creditor if all else fails. The relatively new Consumer Financial Protection Bureau is a government agency specifically created to make sure, quote, banks, lenders, and other financial companies treat you fairly, unquote. Okay, you've been using credit. Let's watch for these signs that you may be in trouble. First big one, paying only the minimum balance each month. This is a definite problem. Trouble even paying the minimum balance. This is bad. Total balance increases every month. You are not making progress. Missing loan payments or paying late. This will affect your credit rating quickly. Using savings to pay for necessities. A sure sign you're overspending. Getting second or third payment notices. Borrowing money to pay old debts. Exceeding the credit limits on your credit cards. Or being denied credit due to a bad credit report. I don't think any of these need much explanation. If any of these begin to occur, it's time to take a serious look at your spending habits and your use of credit before you're in too deep to get out. If you have a debt that goes to collections, there are laws that govern what actions debt collectors can take. For example, this usually prohibits calls before 8 a.m. or after 9 p.m. or at times that are known to be inconvenient for the debtor. If you find yourself in trouble with your debt, there are a variety of services available to provide education, develop a spending plan, and help you work out debt consolidation plans. Most of these services are low or no cost and are well worth the effort to keep you out of bankruptcy. Counseling services are available at many other venues. Family Services, for one, offers credit counseling and will help you with a debt consolidation plan. What if you don't get your debts under control? Bankruptcy may be the only option, and it's a serious one. Remember, it stays on your credit report for 10 years. This could affect your ability to get a job, to get credit again, to buy a car or a home. There are 2 chapters to the Personal Bankruptcy Act. Chapter 7 is straight bankruptcy. Chapter 13 is wage earner. See it on the slide. Bankruptcy should be the last resort because of the damage to your credit rating. Bankruptcies peaked in the U.S. in 2005, dropped drastically, and then climbed again in 2010. Unfortunately, the Memphis area has a very high percentage of personal bankruptcies. Chapter 7 is considered straight bankruptcy and is the most used one. This is basically a fresh start. Most debts are eliminated except child support and alimony, educational loans, taxes, and fines. The majority of assets are sold to pay creditors. Filers usually get to keep their home and auto as well as appliances and the tools required for work. This details more thoroughly what is and is not discharged under a Chapter 7 bankruptcy filing. You may no longer owe retail store charges, bank credit card charges, unsecured loans, unpaid hospital and physician bills. You still may owe certain taxes and fines, child support and alimony, educational loans, and debt from willful or malicious acts, in other words, from crime. The Bankruptcy Abuse Act of 2005, which came right after the height of the filings, was passed to make it more difficult to file a Chapter 7 bankruptcy. It virtually forces a Chapter 13 wage earner filing. Debtors must wait 8 years from a filing to file again. It requires consumer education on debt management, and it cracked down on so-called bankruptcy mills, which I'm sorry to say we had a few in the area. If you file for bankruptcy, there will be lasting effects. Obtaining credit may be harder, and remember, it stays on your credit report for 10 years. Chapter 13 filers will be viewed more positively than Chapter 7 filers. Bankruptcy should truly be the last resort. These final slides review the learning objectives for this chapter. Here we have the advantages and disadvantages of credit, closed and opened-end credit and sources of credit, ratios for measuring credit capacity, national credit bureaus, and the 5 C's of creditworthiness, calculating the cost of credit, what to do if you have a problem with a credit purchase, the variety of laws available offering protection to consumers using credit, and bankruptcy. This ends Chapter 5.